So do either of Vanguard's dividend ETFs deserve any of your attention? Should they be in your portfolio? In this video, we're taking a closer look, a deep dive at the Vanguard Dividend Appreciation ETF, ticker symbol VIG, and the Vanguard High Dividend Yield ETF, ticker symbol VYM. We're going to cover every single thing you need to know, from a general overview of both ETFs to a closer look at each of the underlying indexes they cover. We'll look at the expense ratios, a breakdown of the portfolio, their current dividend yield, dividend growth rate. Does it make sense to own in your own portfolio? How much money in each of these ETFs would you need in your own portfolio in order to generate $50,000 a year in dividend income? We'll also look at how these dividend ETFs are taxed. That's a lot to cover, so let's not waste any time. Let's dive in. Alright, so we're looking at the Vanguard Dividend Appreciation ETF and the Vanguard High Dividend Yield ETF, VYM. Now, one thing you should note is that both of these ETFs are also available as mutual funds through the Admiral Shares Mutual Fund. Whether you buy them as an ETF or as a mutual fund, there's not a significant difference in the actual investment type. The biggest differentiator here is how they're purchased and what price you purchase them for. For the purposes of this review, we're going to look at the ETF version for both. So on Vanguard's website, if we're looking at VYM, it indicates that they seek to track the performance of the FTSE High Dividend Yield Index, which measures the investment return of common stocks of companies characterized by high dividend yields. And for VIG, we see that they seek to track the performance of the S&P US Dividend Growers Index. It's a passively managed full replication approach. So with VYM here, when we're talking about the FTSE High Dividend Yield Index, well, what is that? And to be completely honest, I don't know, because you can't find any information on this FTSE High Dividend Yield Index. So I Googled it, I looked at all these different websites. The biggest thing you can understand on the methodology here is that they include stocks with the highest dividend yields, but they do not include REITs, or real estate investment trusts. The High Dividend Yield Index doesn't appear to exist anymore for FTSE. What appears to be the most relevant is the, right here, FTSE All World High Dividend Yield Index, which is different. Now, we do have information on this other index for VIG, which seeks to track the performance of the S&P US Dividend Growers Index. This information is available on the S&P Global website. The S&P US Dividend Growers Index is designed to measure the performance of US companies that have followed a policy of consistently increasing dividends every year for at least 10 consecutive years. And, importantly, this index excludes the top 25% highest yielding eligible companies from the index. The current market price for VIG is $141.57 as of October 21st, 2022. And for VYM, that market price is $101.41. And one of the greatest things about Vanguard is the fact that they have really low expense ratios. Each of these ETFs has an expense ratio of 0.06%. Let's just say you invested $10,000 in each of these ETFs. The annual cost to own these indexes, to have Vanguard manage this investment on your behalf, is $6. This is significantly lower than most dividend ETFs on the market. All right, let's take a look at portfolio composition. First here, VYM, the High Dividend Yield ETF, has 443 different dividend stocks in the portfolio. And if we look at the exposure to different sectors of the economy, we see that the biggest exposure is to financials at 19.9%. Then we have healthcare at 15.3%. Then we have consumer staples at 13.1%, and then 10% for energy and industrials. Here are the top 10 holdings in VYM. Bristol Myers Squibb, Texas Instruments, Linde PLC, ConocoPhillips, Philip Morris, Comcast, Qualcomm, CVS Health, Raytheon Technologies, and Amgen. None of these have a percentage higher than 1.21%. So you have an extreme amount of diversification with this ETF. With VIG, we have a total of 289 dividend stocks, so not quite as many dividend stocks as we saw with VYM. And you'll notice here the breakdown with VIG is different. We have 22.6% in information technology, much higher than we saw with VYM. Then we also have exposure to healthcare at 16.6%, financials at 14.8%, consumer staples at 13.8%. Energy here is only at 0.1%, whereas it was 10% in the previous, and then industrials at 13.1%. You'll notice the dividend stocks in VIG, the top holdings are much different. United Health Group, Johnson & Johnson, Microsoft, JP Morgan Chase, Procter & Gamble, Home Depot, Visa, MasterCard, Pepsi, and Coca-Cola. And you'll notice that there's not as much diversification here. We saw that the highest exposure to any one dividend stock with VYM was around 1.2%, Here we've got 4, 4, 3, 2, 2, 2, a lot more concentration in the highest dividend stocks in the ETF. This doesn't necessarily mean it's a bad thing. We still have 289 different dividend stocks, and these are still quality companies with a history of raising their dividend. It's just showing that between the two of them, there's less diversification with VIG. Both of these ETFs pay quarterly distributions. So to calculate the dividend yield, we take a look at the most recent 4 quarterly payments for VIG as well as for VYM right here. We add those 4 payments up and divide by the current market price. For VIG, the annual dividend, 2.8763 divided by their current market price, $143.15, equals a dividend yield of exactly 2%. For VYM, we have an annual dividend of 3.2159 divided by a market price of $101.41, which equates to a dividend yield of 3.17%. And while I wouldn't characterize 3.17 as a high dividend yield, it is much higher than VIG at only 2%. Taking a peek in the Seeking Alpha website, we can see for VIG that they have consecutive years of dividend payments of 15 years, and they've been raising their dividend as an ETF every single year now for 8 consecutive years, which is a good track record. With a lot of dividend ETFs, we do not have consistent growth in the dividend year over year. And we see with VYM that their dividend payments are 11 consecutive years of dividend growth, so even better than VIG. So does it make sense to own VIG or VYM in your own dividend portfolio? Well, best answer I can give is, it depends. It depends on what you're trying to accomplish. If we're trying to compare these investments to other high yield dividend ETFs, then these two do not have high yields. You're not going to get as much bang for your buck from that perspective with either VYM or VIG. But what you do get with these ETFs is a significant amount of a diversification and quality investments underlying the ETF. There is much more balance, especially when we look at VIG. There's much more balance here in owning investments that have a focus on increased share price as opposed to just paying out a high dividend yield. And if we were to take a look at most of these companies, while some of them have great dividend track records, Johnson & Johnson has been paying dividends for over 50 years, Microsoft has a long history, so does Procter & Gamble and Home Depot. A lot of these, though, have dividend yields much lower than 2%. 1, 2, definitely below 3% for the most part. There's much more focus on dividend growth, not so much dividend yield, and a focus on increasing the overall value of the stock through the share price. That's not a bad thing, but it definitely should line up with your overall objective. For full awareness here and to understand just how this would impact your dividend portfolio if you were looking to start one today, if you wanted to generate, let's say, $50,000 a year in dividend income, which I would say is very normal and average from how much money you're trying to live off of in retirement. $50,000 here. If we wanted to generate $50,000 from VIG, we would need to own, based on current prices, 17,383.44 shares. And to buy those shares, it would cost us today $2,488,440. That's a lot of money, and if that was our goal here, maybe it's just best to own the S&P 500 and just take withdrawals from the account. If we were to do this with the Vanguard High Yield Dividend ETF, VYM, based on the current dividend and current market prices, it would require us to own 15,547.75 shares, which would cost us right now $1,576,697. Now, that's a lot of money as well. It's not as much as VIG, but just for comparison's sake, we just talked in the previous video about JEPQ from JP Morgan. It's a high dividend yield. In this same scenario, if we were using JEPQ, we'd only have to own 10,167.56 shares, which would only require us to spend right now $437,611.84. That is significantly less than the 1.5 and the 2.4 million required for Vanguard. That doesn't mean that Vanguard doesn't have a place in your portfolio. If your priority is to own quality companies and a very diversified dividend portfolio, maybe you don't need all of your retirement income to come from these investments, then VIG and VYM are definitely going to be quality ETFs to own in the portfolio. Full awareness here, I don't own VIG or VYM, but that's because my investing objectives right now are so different than these two ETFs. And lastly, for full awareness here, all of the companies owned by VIG and VYM are, for the most part, qualified dividend stocks, meaning that any dividends that are paid from VIG or VYM are also going to be qualified dividends, meaning that they get the preferential tax rate, which is equivalent to the long-term capital gains tax rate. Hopefully this breakdown of both VIG and VYM is helpful to you in building your own dividend portfolio and learning more about the types of investments maybe you already own. Make sure to leave your 2 cents down in the comments below. Let me know what you thought about this video. What other types of investments would you like me to profile on the channel? That's all I got for you guys in this video. Have a great rest of your day, and thanks for watching.